Good evening. This is the speculator at Take Your Profits, and I'm going to be going over another post-trade review for trade number 86, which was actually a trend continuation trade off of a failed Gartley trade that took place in the Australian dollar market on trade number 85. So although this is a post-trade review for trade number 86, let's keep in mind that trade number 86 was initiated because of the failure of trade number 85 to follow through in the direction that we anticipated. So because trade number 85 did not follow through in the direction that we anticipated, then that gave us a reason to activate the TCT trade strategy. So going into trade, let's just kind of review trade number 85 really quick, just so you could kind of see what I'm talking about. Trade number 85, if we go to the set strategy, was an entry here in anticipation of the market dropping. However, what we see actually happen, instead of dropping in price and following through with that movement, price actually rallied and continued to go against my original position to eventually get stopped out here at the 1.0365 level. So once I got stopped out here and I was able to identify that the market was indeed continuing on in that direction, I went ahead and initiated a TCT trade on trade number 86. So now going into my basically my trade psychology, my post-trade operational routine, which is the actions I do conduct at the close of every trade in this in retrospect video blog. The first thing I got to ask myself and answer for you, the live studio audience, is whether or not this trade went as planned, and it did not. The trade actually failed, which you can't see here just yet, but you will see how miserably it did fail in a second. But here's the idea. The trade did get stopped out. Okay, and this was the actual move that got the trade to stop out. Once the trade stopped out and continued moving in this direction, I waited for price to retrace to a level of previous structure. So this level had been acting, you can't see it here, but it had been acting as resistance, which is where my stops were at. It broke through resistance, stopping me out of the trade, and then retraced back to that previous level of resistance to then treat it as support. And that is basically the premise of the trend continuation trade is that a previous level of resistance will act as a level of support if broken in the future, and the idea was to take advantage of a trade based on these conditions. So price retested that level of support. If you could see here, not on this candle, but on this candle right here, the price did close above my yellow 13 period simple moving average, which is right here. So once price crossed above this 13 period simple moving average, I was then eligible to take and execute an order to take this trade in the opposite direction of the previous trade, which it would now have been going long or north or up, however you want to call it. But I did execute a long order here, long entry, with my initial targets to be taken out at the previous level of structure, and with my protective stops set right below the previous level of structure here. So if you can see, it was a little bit less than a 1-to-1, or maybe about a 1-to-1 risk to reward profile, being that actually it's less than 1-to-1 because I entered here, so it was more risk than probable reward to the first profit target. Including the 3 profit targets, the risk was balanced with the reward. However, the only risk to reward calculation I do take into consideration is the first profit target. So in this case, the risk to reward profile was a little skewed, which is going to lead me into the second question, which is going to be what can I do to improve this trade, being that this particular trade did fail. But nonetheless, my entry was here, my protective stops were here below structure, and my initial targets were at the previous level of structure. So going into what actually happened with this trade is we can see I entered, the market retraced, didn't take me out on stops, but retested that previous level of price structure that basically qualified me to enter the market once price did cross above the 13-period moving average. And then if you notice, basically this was on a Friday, so that Friday the market just kind of went sideways, and this was the closing candle on Friday, this was the opening candle on Sunday, this long down candle here. And what actually happened is this was a gap down on the Sunday market open, and I was still holding the position. So basically, since it was a gap down, the market opened below my stops, so I had to incur an extra, couple of $100 loss because of this gap down in the market. Which leads me to go ahead and create a new, it already led me to create a rule which states that these trend continuation trades, since they are on a shorter time frame, will no longer be allowed to be held over the weekend because of any gap type situations that might occur, forcing me to take additional losses that I'm willing to take responsibility for. So in this case, I just had to suck it up and eat the additional loss, because we ended up getting stopped out rather than taking out targets in the continuation of the trend. So in this case, this was actually, every other TCT opportunity I had worked, this was the one that didn't work. So, here, this is the importance of trading every opportunity that is available to trade when your strategy does present itself. Because not every opportunity is going to work, and none of us are divine enough to predict the future as to when they're going to work. So the only way to combat whether or not they are going to work or not is to take every instance of an opportunity or of your trading edge, so that way you can statistically measure the actual profitability of trading that particular edge. If you don't actually initiate or execute the orders to actually trade your edge, then you can't really consider yourself a trader now, can you? So in this case, this particular TCT trade did not work. So it didn't go as planned. So going into the second question is, what can I improve, and what steps will I take for improvement? Well, this is just basically a trade strategy that I take to try to make up previous losses, or to try to take advantage of a trend in the opposing direction of a previous trade that was stopped out. So there's nothing really I can say that I can do to actually improve the model itself. But what I can do to improve my particular execution is basically just continue to keep a real close eye on the risk to reward profile. In this case, the risk to reward profile was inverted, so it was not a good scenario for me. So, what would have been more probable for increased profitability would have been once this candle did close above the 13-period simple moving average. Once I realized where my entry would have been and where my targets would have been, the best thing to do would have been to forego executing this trade because the inverted risk profile, and wait for a better entry at a retest of structure like what happened here. Because regardless, if I would have entered my long orders here and the market would have continued to take out the protective stops, the actual loss would have been something like, let me see, that's 0.347, this is 0.3, that would have been like 2 pips. This would have been a 2 pip loss compared to whatever the hell it turned out to be if I would have waited for price to retest this level of structure after closing above the 13-period simple moving average. Now, this isn't to say that every time price closes above the 13-period SMA, I'm going to hesitate in executing my orders to wait for a retest of structure. No, that's not what I'm going to do. What I'm going to do is just keep a vigilant watch of what the risk profile is. And if I get another scenario where the risk profile is inverted like this, what I'm going to do is wait for a better entry after the candle closed above the 13-period simple moving average, and wait for a better location to enter that would have actually reduced the level of risk that I would have actually had to take on this trade. And if I would have done that, I could have trailed stops right here, maybe taken profits here. Nonetheless, I would have not have been faced with dealing with this gap down on the Sunday market open. So in this particular case, the best thing to do is to just keep, for future trades, to improve the profitability of these trades and the winning percentage of these trades. The best thing to do is just to continually keep a close eye on the risk to reward profile, and only take the trades when they exhibit at minimum a 1-to-1 risk to reward profile. So that is the post-trade review for trade number 86, which was a trend continuation trade off of a failed butterfly pattern that was trade number 85. And that's the post-trade review video for today in the In Retrospect video blog. Thanks for watching. Hopefully my experiences serve to help you become a better trader. And this is a speculator signing out. Don't forget, take your profits.